Well, we've been talking about the Wipro boardroom, and it is here now on India Business Hour, the Wipro Management in conversation with Kritika. Let's go across. Kritika, over to you.
Thanks, Shireen. It's been a great quarter for Wipro, as we have been saying right here on CNBC TV 18. The management is all smiles right in front of me. It's been a great quarter, definitely, gentlemen. But TK, let me ask you. You said that Q2 will be better than Q1, and Q3, Q4 will be better than the last 2 quarters. Can I say in that case that with this entire fiscal numbers coming in better than expected, by the end of this fiscal, by FY17, you would be back to industry-leading growth rate?
You know, the funny thing is I was answering this question in a very different way to someone before this. So I was telling them I have 2 choices. One is that if I give full year guidance, then I get bussed by the SEC. If I don't give full year guidance, I get buzzed by you guys.
But no guidance.
So it's between
no guidance. FY17, will you be back to industry-leading growth rate? Let's not put a number to it, but industry-leading.
So here's what it is.
Okay.
So what you're going to read is just this, that in quarter 2, we will do better than quarter 1. In quarter 3 and 4, we'll do better than what we've done in quarter 1 and quarter 2.
Okay.
That's all that I can say at this point of time. Because the minute I say something more than that, I think what will happen is I'll give out guidance, and I don't give guidance. As a company, we don't give guidance, and we don't want to start right now.
Okay. In that case, TK, is there better visibility right now as far as your client mining is concerned, as far as market share is concerned? Are you seeing better visibility right now? Are you better prepared to handle volatility right now as a company, given the strategy that you've been putting into place since the last 3 quarters than you were a year ago?
So it's pretty simple. I think, you know, the funny thing about our business is that if you look at what's hit us in the business last year, it was energy.
Yeah.
Just to give you a sense, and this is a number that most people don't quite relate to, we lost $200 million off our energy base across last year.
Okay.
And that's a pretty significant number. That's taken off almost roughly about 3.3% of my overall growth for the year.
For the full fiscal.
For the full fiscal. So that's a pretty substantial number.
Yeah.
And that happened primarily because of causes which are completely out of our control. The oil price went down, something that we didn't anticipate. Companies cut back, we didn't anticipate that. And in turn, that hit our top line and our bottom line.
Yeah.
That we think is completely washed out.
Okay.
That is behind us. At the current oil price, we believe we have going to have stability in revenue. At least that's what we see now. And the interesting thing is that through consolidation deals, we're actually winning over competition, which is a positive. So because we are gaining market share in energy, we think we are going to be in a better position to compete going forward. Okay. That's one big headwind which is out of the way. Okay. The second big positive for us is that healthcare business continues to grow. You'll see the growth coming back this quarter. Manufacturing, which has lagged for many, many quarters, is going to start seeing growth coming back. Telecom had a muted quarter last quarter. We're going to see growth coming back this quarter. Okay. So all those are positive, and that's what really gives us this positive view of what quarter 2 is going to look like.
Okay. Jatin, coming to you now. The margin question is always to Jatin. So it may sound like glass half empty possibly, but if I look at your margins since FY14 till date, as you admitted that it's low this quarter because of the seasonal impact, but since FY14 till date, margins have gone from FY14 16%, FY15 between 18 to 22%, and now it's at 21%. Yes, your business model is completely different, so I won't compare you to the peers, but by when will you be able to talk about 23, 24, 25% margin ranges?
So, Kritika, let me clarify. I think the numbers that you mentioned were for the total business of Wipro Limited, consolidated when we were existing in our earlier avatar when we had consumer care and others also as part of our business.
Fair enough.
If you see now in 13-14 and 14-15, 13-14 we delivered 22.6%, 14-15 we delivered 22.2%, so it was in a very narrow range performance. Okay. This quarter, quarter 4 performance was 22%, we have become 21%, and it's predominantly investment in terms of the merit salary increases, promotions and employee stock options. We had a tailwind of foreign exchange gain, which we invested back into business in terms of some of the growth programs which can help us improve our customer satisfaction and improve our client mining.
Okay.
So overall, I feel that we had a quite satisfactory performance in quarter one. As we go into quarter two, certainly we have headwinds of 2 months impact of the salary increase, because in quarter one we took only 1 month impact. We give merit salary increase from 1st of June.
Right.
So we have 2 months incremental impact in quarter two. So that's the headwind that we enter the quarter with. And we will have to work with our levers on operating margin in terms of on-site offshore mix, bulge mix, utilization and so on and so forth, so that we are able to squeeze sufficiently in order to mitigate as much as possible this headwind. And that's where we will settle quarter two at. So I feel there is, of course, a pressure on pricing in the market, but we have sufficient levers with us if we are able to challenge our cost structure well enough that we remain ahead of that pricing curve in terms of managing our cost curve. So overall, it has been a satisfactory performance in quarter one. We feel quite happy with it, but we have to keep our eye on the ball and execute even better as we get into quarter two.
Okay, but I know Jatin won't give any guidance, so I won't ask him when you'll be able to touch the 25-26%. Abhi, let me ask you specifically about the two concerned quarters. It's been a good quarter in terms of geography and in terms of vertical growth, as TK was saying, but healthcare and consulting have been a concern, as you said. Last quarter, in fact, the visibility seemed strong in healthcare. So what happened in this quarter? And secondly, what's going on with consulting? I think there was a statement made in the con call which I didn't quite understand, that there could be some shutdowns in the consulting business. Can you clarify on that?
No, so let me answer consulting first and then I'll come to healthcare. So consulting, I think, as you know, it's quite a discretionary business. And one of the things we are also doing is, as I take over the portfolio, we are looking at the strategy in terms of what we want to do in consulting. So there is a little bit of restructuring that is going on to align with the strategy that we are driving for consulting. So there are parts in consulting which are towards driving downstream revenue for us. So, digital consulting, definition of customer journeys and stuff like that, which creates then downstream digital development and engagements for cloud migration and so on and so forth. There is a strong consulting that we do in the infrastructure spaces. Fundamentally, infrastructure service is getting transformed for our customers. Again, cloud provisioning, infrastructure as a service, as we've said, and how customers manage and provision and consume that infrastructure is a big consulting area. Then the traditional IT architecture and technology consulting piece, and then the process consulting, which is process governance and all of those. So those are the areas we are going to focus on. And on the domain side, the industry vertical domains, as well as the functional domains. These are the areas broadly that we will do in consulting. There are some other parts which have been executed in consulting which may not necessarily all belong into consulting, which we are putting it in the places where they belong. So the business doesn't shut down or go away. It just consulting focuses on the value side of the business, and wherever there is downstream volume side of business which is better done within individual service lines is being transferred there. This is part of the overall delivery.
No shutdown there, sir.
No, there is no shutdown as well. This is part of the overall delivery realignment that we have initiated recently. On the healthcare side, I think it is just a quarter issue. There are certain large engagements which got over, and then there are certain engagements which we have won already, but we were expecting to start, but we have not started yet. The signing and other things have taken time, so it will start in the next quarter. We are almost on track to start in Q2. So it is just a one-quarter issue on the healthcare side of the business.
Saurav, usually the silent one. Let me come to you. Utilization is very strong this quarter. Attrition seasonally high. Tell me, in terms of, you've given out wage hikes, as Jatin was saying. Promotions have been given out. By when will you be able to contain attrition? Probably bring it down to the comfort range of 11 to 13%, which most players would like to operate in. And also, is there further room for growth as far as utilization is concerned?
So, Kritika, let me try and give you a full picture on our entire supply chain. If you look at it, good net adds, 3,500 people.
Agreed.
Utilization, if you see, over the last 3 quarters has been going up. And we very confident that we have had space to even make it better. So there is absolutely no issue there. Coming to attrition. Attrition, again, seasonally it's a quarter for us where, because we do an appraisal cycle and we have people going off of higher studies. But if you look at 6 quarters, I'm not talking about 1 or 2 quarters, 6 quarters it is played in a 1% band. So it is very, very predictable. It is very, very, in a narrow band and helps us plan the business better. So if you look at the entire supply chain from hiring ads, the utilization as well as the attrition, it's a pretty robust performance as we look at it. And the initiatives and the interventions we have done, which are on all, you spoke about the wage hikes and promotions and equity to leaders and all that, all will only enable us to make it better. But I think in our business, it's about becoming more predictable about how we manage this. I think, and that's where we have been able to do this well. Obviously, I'm not saying we would like it to be a little lower, and we have a focus on people with skills, right skills and high talent and high performers. These are the 2 areas we keep a focus on. But otherwise, we are fairly comfortable as the way the attrition has panned out over the last 6 quarters.
Is there further scope to growing utilization?
Absolutely. We have huge headspace to look at it.
What's the headspace in that case?
But we are seeing that number. Again, you're asking.
I can't get
like revenue, no guidance, like margin, no guidance, utilization, also no guidance. But very clearly, we are seeing...
the expression changes. Okay, fair enough.
That's right, right?
Okay, pricing. Yes, it's been a concern. And TK, you were probably the first person to admit in the IT industry that yes, pricing has been a concern. There will be pricing pressure, and there is right now. Clients, as you said, are consolidating. That is reflecting into pricing pressure, thereby reflecting into margins. What are you doing right now? In the next 2 to 3 immediate quarters, what are you doing to be able to contain that pricing pressure that is evident in the traditional side of the business, not in the chain side?
So let me explain what's happening, how the scenario is playing out in the marketplace, because that will give you a sense of why pricing pressure is happening. If I look at the run side of the business, and if I go back, say, 2 years out into 2013-14, 80% of the deals that we competed for on the run side of the business were with global majors. This year, 60% of the deals that we're competing with are with global majors. So, which means that the Indian players have now come to 40% of the total portfolio.
40%?
Those are the guys we're competing with right now when they go up for renewals.
Okay.
When you compete with an Indian player, they have the same cost advantage that you have. So really, to remain competitive and to keep your margin where it should be, you really have to drive differentiators in terms of hyper-automation. That's the only lever that you have.
Okay.
Last quarter, what we have done is that we have implemented our platform homes across the board. We've got 70 projects running on it.
Okay.
We've released about 1,000 people, approximately, give or take 100, out of our current project base and redeployed them into other projects. So that's the kind of core of productivity that we're seeing there. So while we see drop in terms of pricing, we see that being made up by productivity.
Yes, that's the Wipro top management talking about the stellar first quarter performance, not giving an official guidance. All they're saying is second quarter will be better than first quarter, second half will be better than first half, but indicating the telecom, healthcare should be areas of growth. With that, it's time for a short commercial break. On the other side, we're going to get to the latest on the ongoing legal battle between the government and Nestle. Stay tuned for that.